Hello, everyone, and welcome to Build Your Legacy, an overview of legacy giving strategies with the Pediatric Retinal Research Foundation and Rick Deyo. We're excited you could join us this evening. So I have just a few slides here that I'll share with you, if it works. It might be too far. All right, let's see if this works. All right, sorry about that. So my name is Stephanie Seville. I'm the foundation manager for the Pediatric Retinal Research Foundation, and I'll be your host tonight before I turn it over to Rick. For those of you who are joining us, we're going to talk a little bit about the Pediatric Retinal Research Foundation, spend a short time on that. We're going to do the bulk of our program talking about a review of charitable giving mechanisms. We are going to do a live Q&A, so we'll have a large portion of tonight's event dedicated to answering your questions, and then we'll do a brief closing before we part for the evening. So first thing, I want to remind everyone that this meeting is going to be recorded, and we'll send a link out to everyone. All guest cameras and microphones are automatically off. However, when we do the live Q&A, we do encourage you to turn on your camera and turn on your microphone so we can interact with you directly. If you would like to submit questions for the Q&A, please put your questions in the chat, and we will either call out on people who are have their hand raised through the Zoom feature, or we'll read the questions out loud for Rick to address. Before we dive into our content, we're always having to put a disclaimer up to make everyone aware that this information provided tonight doesn't represent any of the companies that Rick or I are associated with, or the Pediatric Retinal Research Foundation. Rick is a wonderful volunteer, so this advice is to help you with your financial decisions, but it is not considered financial or legal advice. So most of you joining today are familiar with the Pediatric Retinal Research Foundation, but just in case we have some new faces, I want to go ahead and cover a little bit about PRRF. Our mission is to support the community impacted by blinding pediatric retinal diseases, and our focus is on championing the quest for cures through innovation. So how we achieve our mission, a large portion of our effort is dedicated to translational research. What that means is we focus our efforts on research in the medical lab, and then we try to bring that to bedside through different drugs and therapeutic options that will hopefully be available directly to folks that need them. Part of our research program also includes our ophthalmic biobank, and if you want to learn a little bit more about that, please visit our website. And the second half of what we do is focused on community programming. That is a newer feature of the foundation. We're really excited to offer a lot of educational advocacy. We have a ton of resources on our website. And if you've been engaged with the foundation in the past year or so, you've noticed we've brought a lot of webinars and educational resources for free to the community. So we're excited to bring this event as part of our educational advocacy. So I'm very excited to introduce our presenter tonight. Rick Deyo and I have known each other for about a year or so now, and he is a very passionate volunteer for the Pediatric Retinal Research Foundation. He's going to give you a bit about his own background, but Rick is a financial consultant as a professional business, and he also is chartered advisor in philanthropy. Rick is about to earn his master's degree, and I had to write it down so I didn't mess it up, but he's earning a financial planning master's with a focus on legacy giving, which is charitable giving. And he's getting that from the American College of Financial Services. So we're very excited to see all of the things that come out of that program. So now, without further ado, I'm going to turn the program over to Rick and let him give you the program for this evening.
Okay. Thank you, Stephanie. It's obviously a joy to be here, a delight really, because this organization fits into my legacy of my life story. And if you've had a chance to watch that, we'd encourage you to do that. My whole goal with that is to provide encouragement to you. I have lived now with ROP, which is retinopathy of prematurity, for, I'm dating myself here, 69 years, soon to be 70 years. So my particular eye condition is such that I do not see out of my right eye. I do see out of my left eye, but the eye turns to the left to focus on the good part of the retina in the back. And so there's a long story there, and we're not going to go into that tonight, but that's my background. How I became associated with Dr. Michael Tracy and Dr. Antonio Capone was really unbeknown to me at the time. I had cataract removal at Wills Eye Hospital in Philadelphia in 1994, went from 20/50 on the eye chart to 20/25. And I tell people I memorize those eye charts. So I hope you're laughing at that, okay? And so anyways, a couple of years ago, I was transitioning from Wills Eye Hospital and a specialist there, and I came across Dr. Michael Tracy, and the rest is history. In fact, I grew up in Livonia, Michigan, just west of here, and attended Eastern Michigan University, where I ran track and cross country in 1970 to 72. So that's my connection to the Detroit area. I was born here, grew up here, and so let's begin. I want to thank some people. I want to particularly thank Stephanie Seville for all the work that she has done in putting together this webinar, this seminar. It's just an outstanding slides and presentation, and I'm sure that you'll, it might be nice to write her a thank you note. Anyways, the other thing I'd like to share regarding that is, is the reason I'm passionate about charitable giving is throughout my financial services career, it seems that I would always gravitate to raising funds for not-for-profit organizations. For example, we co-founded Habitat for Humanity in our community, raised $24,000, built a brand new house. Worked on a Moody Broadcasting Christian radio station, raised $500,000. And most recently ran the Boston Marathon and raised $30,000 for Helen Keller's organization, the Massachusetts Association of the Blind. So throughout my career, there's been this passion of raising funds to make a difference in the world we live in. So that's kind of my background. And then you can take notes on this. I spent almost 3 years with a charitable remainder trust organization called Renaissance Administration in Indianapolis, where I was an internal consultant with financial advisors and attorneys in drafting documents for charitable remainder trusts. And probably over that period of time, I worked on 250 trusts. And in my lifetime, maybe $380 million will go to charities, everything from the Red Cross to Sierra Club to Focus on the Family. So you can see that all this is coming together, all these tools and all these experiences that I think it's very providential that I can use these experiences and this education and all the good things that have happened with the Pediatric Retina Research Foundation. So with that, as by way of background, let's look at our start here regarding vision, peace, and satisfaction. So without a vision, people perish. They have no direction. So our goal here tonight is that when you leave this meeting, this seminar, you will have a clear vision, no pun intended, okay? A clear vision of how you can make a difference regardless of the size of gift, and you can participate. And then you would have peace about that avenue of giving, whatever strategy you choose to use. You'll have peace about that because it will not hamper your retirement plans or your gifting to your heirs. And then obviously, lastly, you have the personal satisfaction that regardless of the size of the gift, you have made a difference. And it's all of us working together as a team effort, whether you support the Pediatric Retina Research Foundation or you support another charity that you're really passionate about. Okay, so let's start. And I want to start with a book that impacted my life. And I think you'll see why this book is significant through the seminar. It's called The Art of Teaching by Gilbert Hyatt, Highet, copyrighted 1950, okay, Columbia University professor. And the whole premise behind the book is that there's an art to teaching. And, you know, whether it's enthusiasm, whether it's a passion, or it's not just information, all right? So just as a disclaimer here, a couple of things I forgot to mention. I am not here to get new clients, okay, or referrals. This is purely my effort to volunteer my services and experiences to further the cause of the Pediatric Retina Research Foundation and maybe charities that you're associated with that you have a passion about. Okay, all right. So this book really instilled in me that not only when we're teaching or public speaking, we try to make things practical and relevant. And I'm going to try to do that tonight. And even though we're giving a high view overview of charitable giving strategies, I'm going to try very hard not to get into the weeds of the minutia, okay? But I'm going to give you ideas and some of the pitfalls to avoid and some of the benefits, okay? All right. So first one, we want to talk about immediate gifts that we could make today or tomorrow, next month, next year. And one of those is an annual gift fund that the Pediatric Retina Research Foundation conducts, and many organizations do. They call it the annual fund. And it is primarily designed to support immediate ongoing expenses of the foundation. And, you know, those gifts can obviously cash gifts, monthly, consistent contributions every month. Because I'm a runner, I might call them endurance partner gifts. Like it helps us plan a budget, and the gifts are given systematically so that the foundation directors can plan a budget. Okay, and so that's how that works. Now, you could also give appreciated stock. The stock market has had a great run up until just recently because of the Ukraine war, and we've had a pullback and the threat of inflation and so forth and so on. But we've had a great run up, and you may have appreciated stock or equities, and you could gift those or a portion of those. If you have a mutual fund, it's in a taxable account. You could give a portion of that to your favorite charity, and you would get a tax deduction for that. And then the charity would sell that. You would avoid the capital gains tax. And lo and behold, the charity would have proceeds to use for their annual fund. Okay, so that is That is one way you could benefit immediately a local charity, whether it's the Red Cross, Rescue Mission, School of the Blind, whatever charity, as long as it's a 501c3 organization, you could do that. Another way that you could make an immediate gift, and it's a little more complicated, but it's very significant. Under IRS rules, you can gift annually up to, and you can do obviously less than this, $100,000 from your IRA. So you may have an IRA that you don't need. You have a pension, you have sufficient funds, maybe you have rental properties and you have sufficient income and you have Social Security, but you don't need this IRA. Well, under the IRS rules, you could gift up to $100,000 every single year out of that IRA. Now, there's another little caveat that is similar. It's almost what I would call a kissing cousin, okay? And that is a beneficiary IRA. A beneficiary IRA is an IRA that you have inherited from someone, a grandparent, a mother and dad, an aunt and uncle, and it is set up as an inherited IRA, and it's called a beneficiary IRA. And there are rules that you have to follow to take distributions from that. Now, this is where it gets a little complicated, but I want to explain it. Prior to the Trump administration, there were 3 ways that you could receive money from an inherited IRA. Number 1, you could take a lump sum. So you inherited $10,000 lump sum. Or you could stretch it out over 10 years and take 1/10 every single year for 10 years. The last way is, this is prior to the Trump administration, is we could stretch that beneficiary IRA for over your lifetime. And what the whole purpose in doing that is to minimize taxes. Now, if you want to make an immediate gift, you could gift a portion of that lump sum or that 10-year 1/10, because that's how that would work, okay? Now, after Trump administration did away with the stretch of that IRA, so now we're left with only really 2 options, either a lump sum, well, I'll take it back, 3 options. Lump sum, 1/10 every 10 for the 10 years, or at the end of the 10 years, you have to take a lump sum. Now, if you don't choose one of those options, then the taxation of that beneficiary IRA is taxed at 50%. So you need to talk to your financial advisor or an accountant, CPA, your tax preparer, and make sure that you're doing the right thing so you can avoid the taxes. But you could make an immediate gift from an inherited IRA. Okay. All right. Now, next one is what we call a retirement IRA that we are going to redirect the required minimum distributions for someone that is either currently taking required minimum distributions or is about to take those required minimum distribution or will be anticipating taking required minimum distributions. So let me explain the required minimum distribution rules, okay? Prior to the Trump administration, they were, very simply, at age 70 and a half, we must take a required minimum distribution in the year that you turn 70 and a half. Or you could delay to the following year and take 2 required minimum distributions. And the calculation is an IRS calculation. It's about 4%. And it's based on the previous year's 12/31 value of your IRA account. Well, then during the Trump administration, those rules changed. And for many years, I thought that Congress would go in the opposite direction that they went in. I thought that they would change the rules to make the required minimum distribution active sooner rather than later at 70 and a half. I thought, well, they'll make it at age 68 because Congress needs more money. Well, they didn't. They moved it under Trump administration to 72. So if you have not taken your required minimum distribution yet, and you're going to turn 72 this year, well, that's a great thing. You don't have to pull money out until this year or next year or whenever you turn 72. Now, the interesting thing is that the House of Representatives just passed a law, and it was a bipartisan agreement. Can you imagine that? Okay. But they have moved the date and the year and the age even further out. They've moved it out over the next 3 years to age 75. So you may be asking the question, well, why would they do that? Well, because they want people to work longer, save more, and not have to take money from their retirement account. It's the exact opposite of what I've ever thought about our federal government and congressmen and women wanting to do. So that's a good thing to move it out further. Now, obviously, you can take money out of your retirement account anytime you want to after 59 and a half, but you are required now once you turn 72, you have to start that required minimum distribution. All right, so now you're asking a question, what does that have to do with charitable giving? Well, simply this way. Let's say today, this year, you're writing a check to your local church or your local charity, and you're donating those funds out of your checking account from income that you're receiving. Wouldn't it be neat if you could redirect the same giving amount from your required minimum distribution? Instead of taking required minimum distribution as income, you are now redirecting it directly to the charity. So that's how that would work. So as long as you're not taking the required minimum distribution and receiving it yourself, and you're redirecting it directly to the charity, you avoid the income taxation of that required minimum distribution. Now, I left out a little sentence there. You may not get a charitable deduction. Why? Well, because most of us now don't itemize. And most of us have a $24,000, $25,000 this year exemption. So unless you are itemizing that gift to your charity, whether you write a check or you redirect your required minimum distribution, you may not get a charitable deduction, but you avoid the income taxation of it, which is a good thing. So that leads me to a quote that I want to read to you by a gentleman that I heard many years ago. And it's Judge Leland Hand. And here's what he said about the taxation of our income. Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging our affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do it right, for nobody owes any public duty to pay more than the law demands. So you shouldn't feel guilty about not paying more taxes. And then there's another quote. In America, there are two tax systems, one for the informed and one for the uninformed. Both are legal. Okay. So my point is simply this, that these are legitimate tax avoidance strategies, okay? And that's a good thing. And we just need to be informed. And that's one of the purposes tonight, so that you can walk away from here with something that's relevant, practical, and you'll be informed. So All right. So where are we next? Donor advised fund. So we're going to transition now to a strategy and a product that will cover not only immediate gifts, but gifts that could materialize in the future. Now, excuse me, I have been fighting a sore throat and I'm here. All right, so a donor advised fund, a DAF, DAF, is much like a private foundation. Now, in order to have a private foundation, most folks need $3 to $5 million. Well, a donor advised fund, you don't need that. And even though on the screen it says that you have to have a minimum of $5,000, there's kind of an exception to that. It depends on who the custodian is of the funds. So you open up a donor advised fund and then you fund it, okay, with stock, mutual funds, cash, donations. And that platform that is holding those funds, whether it's Fidelity, Schwab, TD Ameritrade, Pershing, whoever it is, they may have a minimum. They may say, well, you have to have $1,000, or somebody else will say, well, 2,500 or 5,000. So it really depends on who the custodian is of the donated funds. So, okay. Now, how does a donor advised fund work? Well, you donate cash or stocks, appreciated assets. You could even donate raw land. This is land that is undeveloped, okay? And you'd have to get a qualified appraisal, and you have to have an appraiser appraise the land, but you could donate that, and then you get a charitable deduction based on the type of asset, whether it's stock, cash, or land. And that, and this is as deep as I'm going to get, depending on the asset, you will get a 20, 30, or 50% deduction off your adjusted gross income for the year in which you make that donation. And whatever you don't use that year carries forward until you use up all that deduction. What else about a donor advised fund that's unique? Well, just like a private foundation has to make grants, issue grants every year to their charities that they want to support. Well, a donor advised fund does the same thing. They must distribute 5% of the proceeds, the total value of the fund, to a group or single charity. And what's really neat about a donor advised fund is you could make it, title it the Deyo Family Donor Advised Fund. And then mom and dad could sit there with the children, and they as a family can decide what charities they want to support, and then it can perpetuate itself to the next generation. I mean, you talk about a legacy here. You don't have the fees of a private foundation. You don't have the administrative costs. And it's just, this is a wonderful vehicle to teach stewardship, thankfulness, gratefulness, charitable compassion. Okay. So that's a unique way to do it without having to have $3 to $5 million, because you can open it for so much less. Now, that's immediate gifts. So every year it has to distribute 5%, and they can you can change the recipients of those grant requests. I have several donor advised funds that I manage, and we're into the grandchildren now perpetuating what grandma and grandpa did many years ago. I mean, this really is what legacy planning is all about. And you can stipulate in your bylaws and the registration of the donor advised fund, maybe some boundaries, some criterias that the donor advised fund will follow to perpetuate the intent of grandma and grandpa. Okay, so there's a lot of flexibility here, and it's really cool. So then, what is, if this is a transitional gift, what is the end result? Well, you know, at some point, the funds are going to be depleted, or you may set it up and say, well, the great grandchildren don't want to perpetuate this any further, so they want to shut it down and close it. And so then there's a legacy gift made to either a single charity or many charities. So you have the benefit of both worlds here. You have immediate gifts every year, and then you have an end time gift. And that's why it's a transitional strategy. Okay. All right. Let me stop talking here for a moment and get a drink of water. And okay, so now we're going to go into legacy gifts, and I'm going to start out with one that I just thought about, and it's somewhat complicated, but I'm going to make it as simple as possible. It's called a charitable lead trust. Okay. And what is unique about it is, think of it this way: immediate gifts of income to a charity for a set period of time. So let's say 10 years. So we establish a charitable lead trust. We fund it with a particular stock or an income producing shares of stock in a privately held corporation that will produce income. Every single year, the charity gets income for 10 years. And then at the end of the 10 years, that stock reverts back to the original owners. So let me give you an example. Let's say I inherited ExxonMobil and I have 1,000 shares of ExxonMobil. And I have this particular charity that happens to be the Pediatric Retina Research Foundation that I really am passionate about. So I place the ExxonMobil stock in this charitable lead trust, and it pays out income because ExxonMobil pays a really good dividend. The charity gets the dividend annually every single year. And at the end of the 10 years, I still have retained ownership of that stock because it comes back to me because I inherited it prior to my putting it in the charitable lead trust. There you go. That's one. All right. So now we want to transition here to probably the most commonly used trusts that produce an immediate income for the donor and then passes on a gift because of the charitable intent at the death of the donor. And we call that gift the corpus or the principal. Okay. So we call these charitable remainder trusts. And that's the generic term. And there are two types of charitable remainder trusts underneath that heading. Okay. First one is what we would call a standard charitable remainder unit trust. Standard. Well, what's unique about it? Well, it generates income to the donor or the donor and the spouse, okay? Or a combination of family members, okay? And that income is based on a percentage, but there has to be charitable intent. If you set the payout rate too high, the IRS is going to look at that and say, well, you're going to use up all the funds, and then the charity is not going to receive anything at the end. So if you were to set like a 10% payout rate, well, that isn't going to fly. All right. Most of the time, these charitable remainder trusts are set in the range of 3 to 5%. So average 4%. And then there's a whole discussion of the type of investments that are inside there. But they have to be, that portfolio of investments have to generate enough income so that you don't go into principal, so that the charity doesn't get something in 20, 30, or 40 years. See? So that's a standard charitable remainder unit trust. And I want to put a parentheses here, a caveat, and I want to caution you that these are complex instruments. As much as the average attorney would want to say that they could draft their own document, please don't try to do that. You can go to Renaissance or other capable administration companies that do the tax return on these trusts. They have prototype documents. It's much better for someone to use a prototype document than to find out later, after this is all put in place, that it's not going to accomplish what you want to accomplish. If you have a document that is not drawn up by Renaissance or using their prototype documents or some other administration company of charitable remainder trusts, and you use your local attorney and you find out that there's problems and you have to go to court, most judges are not going to look favorable on that situation. Okay. So I want to caution everyone right off the bat that you need to work with attorneys that are willing to, they'll still get paid, okay, for drafting the documents, but they're willing to go to the experts for the prototype documents. Okay. All right. Now, so that's a standard charitable unit trust, immediate income, and then there has to be in charitable intent, and you have to set the payout rate in a range that is reasonable, and you can set it for a term of years, or you can set it for the lifetime expectancy until death of the donor. Okay. All right. What's the next one? Next one is what we call a NIMCRUT, net income makeup trust, unit trust. Well, what's that? Well, in the very simplest term, it operates very similar to a standard trust in that at some point, income is going to be generated and come back to the donor. But there's a period of time we're going to delay that income because we're going to make it up. All right. So here's some scenarios of how that would work. Maybe we put in a NIMCRUT, an investment vehicle that defers, that has a deferral to it, like a variable annuity or a fixed indexed annuity. It doesn't have to be a qualified plan like an IRA to get deferral. You can use an annuity to get the deferral, and then at some point in the future, that asset has grown, maybe using the rule of 72. Okay, so if we get 10% a return on the investment, the money will double in 7.2 years. If we get 7.2% on the funds, it'll double in 10 years. So we place a variable annuity in that contract. The money grows for 10 years. At the end of the 10 years, we now turn on income. That's a NIMCRUT. Now, there's another way that you could use this. Let's say you have raw land, farmland, or just a lot somewhere, 10 acres, 20 acres, 100 acres, and you want to contribute that land because it's appreciated in value, and you want to contribute to the NIMCRUT. Well, you need to get a qualified appraiser. You need to have a qualified appraisal done, okay? And then you place the land in the NIMCRUT, the deed, and then you wait until you have a buyer. If you have a prearranged sale, that's a step transaction and the IRS will disavow it. So you cannot have a prearranged sale. So you put the land in the NIMCRUT and now you're waiting for that buyer to come along. And this has happened very frequently in the Indianapolis area. I have clients that the subdivisions are moving further and further north and their farmland is becoming more valuable and more valuable at like $35,000 an acre. So you have 10 acres. Well, you can figure out how much that's going to be. Well, they put that land in the NIMCRUT and now they have a buyer and they buy. Now there's cash in the NIMCRUT and that triggering event, the sale of the land, then triggers it to flip to a standard trust that will produce income to the donor. And I mean, it's really a cool thing. So that's how that works. Okay. So quickly, last two things is bequests. We do those through a will. You draw up a will and you can stipulate in your will out of your estate, you give X number of dollars to whatever charities you want to, and that happens. And the last one is life insurance. You take out a life insurance policy and you want a percentage of those proceeds. So you name the charity. The only thing you have to caution about is, well, what happens if that charity goes out of business? So you got to have it flexible enough to revisit it every so often to make sure that your beneficiaries are up to date. So if you have life insurance policies and you've made those decisions, it really is good to revisit that about every 5 years to make sure that your wishes are carried out, whether it's in your will or your life insurance. So that ends our seminar. So Stephanie, how are we doing?
We're doing great. So now we want to open it up to live Q&A. So if anybody would like to put a question in the chat, Rick would be happy to answer your questions. I also invite you to come off mute at this point if you prefer to just speak your question directly. So do we have anyone in the audience that has any questions for Rick?
I didn't do that good a job.
So I have a question. What if you have a life insurance beneficiary and that organization does go out of business and you did not update your information? What happens to those funds?
That's an excellent question. I don't know. I've never had that happen. And I'll answer it this way. Give me 24 hours, I'll find the answer and I'll get back with you.
Thank you.
Yep.
Okay, I see that you went off mute. Do you have a question?
Yes. Why would you do a charitable remainder instead of doing just a direct bequest? What advantages does one have over the other?
Well, a charitable remainder trust, you receive income every year, where a direct bequest, you don't.
Well, you own the stock then and you have the income and you get it anyway.
Oh, I see what you're saying.
Yes.
Yeah. Well, if you do a direct, are you gifting the stock directly to the charity?
It could be arranged that way.
It could be.
Yeah.
But then if you did that, you would give up the dividends and the income. So what the charitable remainder trust does is it allows you to receive income while still fulfilling your charitable intent at some point in the future. Does that help answer the question or not? Maybe I didn't understand all of it.
Well, it seems to me that what the main advantage is if you set up your charitable remainder trust, you lose some control over it. Is that true?
That is true. That is very true. Yes, because you have made a completed gift. and you no longer own those shares of that stock.
So
And-
if you're worried about that kind of control, you shouldn't do that. But if you have confidence in the organization, at the end of the 10 years, then it belongs to them, or?
Well, okay, now we're talking two different things.
Yeah.
If you could do a charitable lead trust, put the stock into the charitable lead trust, the dividends support the charity for that 10 years. And then at the end of that term, that stock comes back to you because you have you have what am I looking for? An ownership interest in it.
Mhm.
So you could do a charitable lead trust and still retain the fact that that stock could stay in your family.
Mhm.
Yep.
Okay, thank
Does
you.
that help?
Yeah, thank you.
Okay, good question.
Do we have any other questions from the audience?
I have one other question. Who is the best person to help you decide among these things? A financial advisor, or how do you choose which way might be the best solution for what you are trying to do?
Well, the short answer is your personal financial advisor should be able to assist you. If they are not knowledgeable on these types of things, then a foundation gift planning officer or somebody like myself that is working with the Pediatric Retina Research Foundation could come alongside you and your financial advisor to more deeply explain all the advantages and disadvantages of each one of these strategies.
Because it would partially depend on what you're trying to do, wouldn't it?
Well, absolutely. Number one, you have to have donor intent. You have to be charitably inclined. And then there's an element of you give up control. And then the other question you want to ask yourself is, do I need income?
Mhm.
Those are basically the three things you needed to think about.
Okay, thank you.
Welcome.
And I will say, Rick has generously offered anybody who has additional questions after the webinar, you can reach out to Stephanie, my email, and I will connect you with Rick. And he's happy to have a conversation with you, with your financial advisor, to pursue any other more in-depth questions.
Great.
We're going to move on now, since I'm not seeing any other questions come up, and wrap up today's webinar. You want to talk a little bit? I think I just said this.
Yes, you did.
All right, so that concludes our webinar for the day. We certainly invite you to stay in touch with the Pediatric Retinal Research Foundation. Visit our website for upcoming events and latest information. We also have a regular e-newsletter that we send out every other month. If you're interested, you can sign up on our website. And of course, we're on Facebook and LinkedIn, so take a look, and we have a lot of great information coming out regularly on our social media pages. So thank you so much for joining us tonight. If you have any follow-up questions, please send that along. We're happy to direct you and help you. And we hope you found this information informative. Thank you so much for having joining us tonight, and have a wonderful evening.
And thank you, Rick.
You're welcome.